So let's start with talking about annuities. Let's start with the opinion for those of you who won't listen to everything else. Almost nobody needs to buy an annuity. Okay, that's the truth of the matter. This is a superfluous financial product, and many annuities are terrible financial products designed to be sold and not bought. All right, so that's the general mindset you should start with when we start talking about annuities. Now, of course, as I get into the information, you might come up with some bizarro reason why you might actually want an annuity. And it's not that every annuity out there is a bad annuity, but you need to understand what they are. Okay, they come in many different flavors, but all of them are an insurance product with some sort of an investment characteristic. At its most basic level, an annuity is just a pension that you purchase from an insurance company. You give the company a lump sum of money, and in return, it pays you a guaranteed amount every month or every year until you die. And as an insurance product, the company generally pays a commission to the agent selling it to you. The agent, of course, often masquerades as a financial advisor, but at least when they're selling you that annuity, they're functioning as a salesperson and not an unbiased advisor. The annuity is backed by the insurance company. So if the insurance company goes away, so does the annuity, except as provided for by a state insurance guarantee organization. Okay? Those are not the state. They are all the insurance companies in the state. Very different. All right. Now, generally works out okay, but they only protect a limited amount of an annuity's value. So you can only put a certain amount into an annuity and have any protection behind it besides that insurance company. So think about annuities in general as a way to spend your money, not a way to invest your money. And the reason why is because the investment returns are usually not that good. The reason you're buying it is because you find the guarantees provided by the annuity to be valuable. For example, if you were buying that classic annuity I mentioned, also known as a single premium immediate annuity, you find the guarantee that you will never run out of money to be valuable. And you're willing to give up potentially better return you could get with more standard investments in order to have that guarantee. All right, so annuities are taxable for the most part. Now, it's important to understand how they're taxed. And it depends, how it's taxed depends on whether it's inside or outside of a retirement account. If it's inside a retirement account, there's no taxation due except on what comes out of the retirement account. And then, of course, every dime that comes out of that retirement account is taxed at ordinary income tax rates. Now, if it's a Roth account, that's not the case. But inside a tax-deferred account, that is the case. If the entire IRA is invested in an annuity, the entire annuity payout takes the place of any required minimum distribution that you're required to take, starting at various ages, soon to be age 75 for everybody. Outside of a retirement account, an annuity has its own unique taxation. In this classic scenario where you're buying a pension from an insurance company, part of the monthly payout is interest. That's taxable rather, at ordinary income tax rates. And part of that is just a return of your principal, which of course is tax-free. So this ratio of principal payout to total payout, which is the principal plus the interest, is the exclusion ratio. And the exclusion ratio varies according to how much principal was used to purchase it, how long you've had it, and the interest rate on the annuity. So it's calculated to spread out the principal withdrawals over your remaining life expectancy. So that's the way the tax works. If you withdraw money from an annuity, like a partial surrender of a cash value life insurance, the interest comes out first. That's very different from cash value life insurance, where you take out the principal first in a partial surrender situation. When you partially cash out of an annuity, you get the interest first. So it's not a very tax efficient thing to do. And of course, annuities are supposed to be a type of retirement product. And so withdrawals prior to age 59 and a half are also subject to a 10% penalty. Of course, any growth inside the annuity, like growth in a retirement account, is tax protected. So you don't have to pay taxes on the interest and dividends and capital gains as the money grows, only when it's taken out of the annuity. And remember, of course, that it takes many years of tax-deferred growth, tax-protected growth, especially if the underlying asset inside the annuity is relatively tax efficient, to make up for this part of the taxation of annuities. When the money comes out, you pay ordinary income tax rates on the gains, not the lower qualified dividend or long-term capital gains rates. Now, if you inherit a non-qualified annuity, meaning one that's not in a retirement account, you can spread the withdrawals out over the rest of your life if you want. But you're still going to pay ordinary income tax rates on the gains when you do take them out. And so the sooner you want the money, the sooner you're going to pay the taxes. If you also inherit an IRA, though, you can actually roll that annuity into the IRA if you like. Of course, then the money becomes subject to inherited IRA rules. And then if your annuity is inside a qualified plan, if it's a qualified annuity, it basically just follows inherited IRA rules as well. Okay, so the main issue I have with annuities is the same problem I have with whole life insurance, and it's the way they're sold. They tend to be a financial product that is sold, not bought, and often sold inappropriately. It's sold to people by making them afraid, make them afraid of higher returning, but more volatile investments like the stock market or real estate, those sorts of things. It's also sold by pointing out all kinds of cool bells and whistles that get it added onto the annuity for a price. The problem with those bells and whistles is that they're not really worth what you pay for them. So that makes it difficult to compare one annuity to another in a fair way. Right? So you do get some benefits, but they're really expensive benefits. So the commissions on an annuity are typically in the 1 to 10% range. And that might sound like a lot to you if you're used to paying $5 to trade a share at Vanguard or Fidelity. But it's actually dramatically less than what might be paid for whole life insurance, which is 50 to 110% of the first year's premium. The more complex the annuity, the more opaque its features, the higher the commission tends to be. For example, one type I really don't like is called a fixed index annuity. I don't know if they're trying to capitalize on the popularity of index funds or what, but that pays a commission of 6 to 8%. More vanilla ones I mentioned earlier, these SPIAs, tend to have commissions in the 1 to 3% range. So those commissions are built into the price of the annuity, not a separate charge. But if you're paying them nonetheless. Okay? More complex annuities might have other fees, surrender charges, mortality charges, administrative fees, expense ratios, etc. Okay? You got to really read the fine print. It's really the most important print in the document, to be honest. Okay, so let's talk a little bit about the various kinds of annuities and when you might want to consider them. Okay, the first one we mentioned, the SPIA. If you want to guarantee you don't run out of money, buy a SPIA. Single premium, immediate annuity. Give them a lump sum of money, and you get the a certain payout every month for the rest of your life. That payout is determined by how old you are. It's also determined by what current interest rates are. So you're getting a little more on these than you were a couple of years ago. But the way you make out well on that deal, of course, is to live a long time. You don't want to, because this thing's going to stop paying when you die. If you die next year, it stops paying, and the insurance company made out like a bandit. You lived 105, you do pretty well, though. In general, people tend to buy these in the 65 to 75-year-old range. It allows you to spend more money than 4%. And that's the real attraction for some people. They go, well, shoot, if I buy one of these at, age 70, I might be able to spend 6% or more of that initial portfolio value rather than 4%. So that can be kind of attractive. You got the guarantee of not running out of money. You can spend more of the money, and of course, you leave nothing for your heirs. So that's the big downside. Okay, another type of annuity that some people might find a benefit for is what's called a deferred income annuity, or a DIA, as opposed to a SPIA. In some ways, a SPIA is longevity insurance, right? It insures against you living a long time. A DIA is kind of like a SPIA on steroids. Instead of paying you out immediately when you give the insurance company the money, it doesn't pay you out for some time, maybe not for 5 years or 20 years. And because of that, because it doesn't pay you for a while, when it does pay you, it can pay you a lot more. For example, let's say you buy an annuity at age 50 that's not going to pay out until you're 80. What's the payout rate? It's about 26% a year of that initial amount that you put in. And that's because the money had 30 years to grow, right? For the insurance company to hold on to it and use it and grow it, right? And so, um, obviously, lots of people die before they get there, but for those who do live that long, it provides this big chunk of money, big chunk of income at the end of life. And some people like that deal. They find that guarantee very valuable. It gives them the mental ability to spend down their portfolio a little more, knowing they've got this DIA payment coming late in retirement if they live a long time. And so they like that. They find that guarantee attractive and buy them. Now, there is a specific type of a DIA, okay? And this was mentioned by the person who wrote in to give us feedback. It's called a QLAC, a Qualified Longevity Annuity Contract. And this is a DIA inside a retirement account. That's all it is. And when the Secure Act 2.0 passed, it allows you now to buy a QLAC with up to $200,000 of your retirement money. Right? So you give the money now to the insurance company, and they don't pay you for many years, any of that money. But the beautiful thing about it, for those who really hate required minimum distributions, is that you don't have to pay required minimum distributions on $200,000 of that retirement money because it's sitting in that QLAC. And so it's a way to lower your RMDs. Now, my argument about RMDs most of the time is they're really not that big of a deal. It's like the best possible financial problem to have RMDs that are more than you actually want to spend. I mean, what a great problem, right? But if you have that problem, this is one option you have to deal with it. Another option might be a qualified charitable distribution, right? That counts as an RMD each year. You can give up to $100,000 a year, not just 100,000 total, but 100,000 per year to a charity, and that counts toward your RMD. Bottom line is the Secure Act 2.0 did make this product, this QLAC product, a little more attractive than it was because it increased the amount you could put in it to 200,000. But the same act also made the benefit a little less attractive because now, at least people that are my age, won't have to pay RMDs until they're 75, starting in 2033. Another type of useful annuity is a multi-year guaranteed annuity, or a MYGA. And this is basically the insurance industry's answer to certificates of deposits that are sold at a bank. You pick the term, you put the money in, the insurance company pays you a guaranteed income as you go along, and you get your principal back at the end. It's like a CD from an insurance company. CDs are backed by the bank and the FDIC. MYGAs are backed by the insurance company and the state guarantee fund. That's probably inferior to FDIC, quite honestly. But if it's paying you a lot more in a CD, it might be worth it to you. One interesting thing about it is CD interest is paid out and taxed as it goes along, but MYGA interest is either paid out and taxed or left to compound tax deferred inside the annuity. So you have this option, right, to not pay taxes on it till the end. You can also exchange it into another MYGA, further deferring the taxation. So that's kind of an advantage over a CD. But given those tax advantages of MYGAs, you kind of might expect them to pay lower yields than a CD. That's not always the case, especially for longer time periods. You might actually get a higher yield on it. So if you're a CD investor, if you find the proposition that CDs make to be attractive to you, you should also be looking at MYGAs. Okay, the last kind of annuity that is occasionally useful to people was also mentioned by the fellow writing in about giving us feedback. This is a low-cost variable annuity. Now, there are lots of variable annuities out there that are not low cost, that have bells and whistles, that have high commissions, that are products designed to be sold and not bought. In fact, if you just remember that variable annuities should be avoided, you're probably going to do just fine in this respect. But there are some uses of a very low-cost one. The first one is when people realize maybe it was a bad idea to get into a whole life policy, but they got a huge difference between what they're going to get out of that policy and what they've put in it. You can exchange the cash value of the whole life policy into a low-cost variable annuity, let it grow back to the basis, to the amount you've paid in premiums, and then cash out of it. And essentially that growth from the basis or from the cash value to the basis then is earned tax-free. So you got to pay some fees to the annuity and deal with some hassle, but you get some tax-free growth. It's probably worth it if that is, tens of thousands of dollars difference If it's a few $100s, it's definitely not worth it. Okay, so that's one use of it. The second use is for someone that just doesn't have very much tax protected space and they want to hold some tax inefficient asset classes. Maybe they want to put tips in there, or REITs in there, or some, debt real estate or something like that. Although I don't know that you can actually get debt real estate into a variable annuity. Is this gives you a chance to put the investment into an environment where it grows in a tax protected way. Now, obviously, it's an annuity. When it comes out, it gets taxed like an annuity, ordinary income tax rates, but at least that allows it to grow in a tax protected way for a while. And if it's a tax inefficient enough investment, it's possible you could come out ahead, assuming the fees on the annuity are low enough. But this is one other option for it. Okay. Things you should avoid for sure, right? Most variable annuities I mentioned to you, especially expensive ones. Fixed index annuities, I see no reason to buy these at all. Really complex annuities. If you can't compare it to annuities from a bunch of other companies, you're probably getting ripped off, right? You want something you can compare, like gasoline, right? If you can buy gas for $3 a gallon, that's a good deal. At $3.40 a gallon, you're getting ripped off, right? It's very easy. You buy it by the price. And you can do that when you can compare annuities one to another. But if they're all totally different, that you're comparing apples to oranges, you just can't tell. All right, enough on annuities. I hope that was in the weeds enough for those of you who are looking for more information on topics like that. But still, an annuity is something that you can just skip over. You don't have to have an annuity in your life and you'll do just fine.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.